All right, gang. Here's a quick trade outlook for some of the markets. First and foremost, take a look. This net is a chart on Netflix, and while we could draw trend lines if I could with a straight line, you got to get the idea. We're starting to fan these out, and they're starting to get a little on the parabolic side. In the difference between the two volume indicators, this is on balance volume right here, and this is my proprietary volume indicator, which takes the rate of change of volume over time and in terms of percentage. It also has a momentum histogram component behind it, and while yes, we have seen in 2018 an uptick in volume, there's nowhere near the kind of volume that we saw way back here in 2014. Now, that could be explained several different ways. More people trading options because as the valuation gets over 100, 200, 300, now close to 400 and change, more people will be apt to trade options on this. Now, here's what I see personally. We have a quarterly pivot resistance in Netflix up and around 413. There was, and that's the red line here. We came close to 405. We've got moving averages way down here, and there is a historic gap between the price and the moving average. So is this a bubble? Let's take a look at other time frames first before answering that. Is this a bubble? Yes or no? Well, now we're going to turn to a couple other things. Here is a weekly chart on Netflix, and Netflix has not been, and again, I repeat, the last time we saw a sell signal, it was reversed immediately 3 weeks later by that buy signal, that PPS buy signal, and now we have broken out. So since the corresponding first rally to the second rally, look at the volume and the momentum behind the volume. It's not as great. In fact, even volume levels back here were greater, showing there was more investment dollars or volume going in it in terms of percentage. Now, if you take a look at, and partly if you take a gander at, look at the length of or distance or appreciation in the on balance volume line here from this level to that level, and then you take a look at the same corresponding time frame, look at the relationship between the last price rally, you can see there's a big difference, and that's why we have a smaller appreciation in the volume right now. But the one thing I want to have you feast your eye on is this. This is an amazing situation. This is a relative strength, the PMC. For you folks that use Thinkorswim, this was added to the John Person file. So with PMC, you can also use Person's pivots. You can also get the PPS indicator. What it's showing us is that the relative strength is disimproving, and it's got this dark blue. Well, it was outperforming, that's bright blue, outperforming the broad market or S&P 500 way back here at the end of 2017. This was a screaming buy. But as we start to make newer highs in the marketplace, and I mean outperforming the market today, you got to admit the market with Netflix outperformed. In other words, Netflix was up and the stock market was down. So with that said, why isn't the relative strength increasing and surging? So over time, the relative strength is starting to show signs of momentum loss. And so that's, I mean, if we take a look at a lot of these relative strength and weakening volumes, while we get the situation where it was starting to decline over here, we get a situation where it was declining and the volume was showing divergence, you got to sell off in the market, right? So here's what I was referring to. And at this point in time, I think it might be prudent, and this is one of the things we discussed as we get closer to that 413 level, to maybe take a stand and use some options and a counter trend bet, so to speak, and look for maybe a 3 to 5 day pullback as we get closer into that 410 area. If we get a gap higher tomorrow, we might just see a little reprieve in the next week to 10 days. So that's what I wanted to share with you on Netflix. Now, last but not least, let's take a look at the daily chart. And here's looking even at the daily analysis. While we do have an uptick in volume, again, we have the volume showing us that it is moving up. Here's the trend up. It's nowhere near the participation rate of where it was back in January. So again, is this because more traders are using options and the buy and holders are already in the game? What the big question I have is, you can see on the daily basis, we have outperformed the broad market, but we're nowhere near where we were back in late January, early February. So this is showing at least signs that it's not the time to be buying at this high. So would it be a prudent thing to pick a top? Well, I think if you do start to see at 413, we're going to get into what's called a market overstretched. And I think even though there was what helped accelerate today's gains in Netflix was there was an upgrade. Someone saying that Netflix can go all the way up to 500. Well, it could, but I don't think it's going to happen immediately. So that gives us possibly a regression or a short-term trade opportunity for the market to maybe dip back into the low 390s. So two ways to play it. If it gets up near that 413 area, then what you can do is look to just be a short-term put option buyer. A short-term meaning this Friday up to next Friday, weekly options. Buy a put option there. Just be slightly directional on a higher open on Wednesday. So if you get that follow through higher open on Wednesday, that's one trade that you would probably look at seeing a regression to the means or a pullback or a sell-off or profit-taking pullback. If this was a short squeeze, anyone that was short the market, they certainly were squeezed, especially since this market has just moved nearly $45 in the last 1, 2, 3, 4, 5, 6, 7 trading sessions. So that's one idea there. Let's move on. All right, what's really going on with the market is, do we get a couple days sell-off and it's a pullback in the market that should be bought, or is this kind of a market starting to roll over? And for that, I kind of look at the PPS signals. So here's what I would say. If we take a look at aerospace defense, XAR, metals and mining, steel stocks, industrials, materials, coal, XLB is another material, transportation, airlines, you'll notice that we get a lot of new flashing weekly sell signals. All of these are sectors that are generating a warning signal today. And let's take a look at ITA, which the ITA is the aerospace defense, but we can also look at the XAR, which is this one right here. So you'll notice that, and I expand the chart up, you will see that we have a 1, a 2, and 3 times the charm, potential triple top in the market, and we're going to generate a sell signal. That's the PPS sell signal. Each corresponding time, except for the very first one, it had a sell signal and jammed right back. The second one had a sell signal and fell through a little bit. Third one, though, is different because now we have a deteriorating relative strength outlook in the market. All right, so I wanted to bring into perspective, again, 1, 2, and third time the charm. Is that a triple top? Well, here's what I wanted to share with you. These are proprietary indicators. This is a momentum indicator that is in relationship to the PPS buy and sell signals, the proprietary moving average, and price. When we start to see the market move away from moving averages and moving averages start to move lower, and it's hard, I'll just try to draw them in there. You can barely see they're not going up, right? The momentum has turned negative. Now, on balance volume has been in a deterioration mode. Hard to maybe see what that's been doing, but over the last few months, since March, we've not seen any progress in the aerospace and defense sector. Now, not to say, who would blame it? After this huge run-up, we are in a consolidation mode. But is this consolidation going to bring us to bigger downturn or longer sideways? At the very least, you would expect bearish to neutral before, or at least some type of a correction is needed or is warranted in this market. So for that, we take a look at another look at the person's market catcher or relative strength indicator, and you can clearly see it started to lose its relative strength in the market, and we're going to just zoom this right up right in here. So versus the S&P, the aerospace and defense sector started to weaken in its performance, and this shows that longer-term investors or fund managers may say, you know what, I'm not getting enough alpha. The beta is starting to collapse a bit, meaning I am not seeing a strong correlation. The stock market's going up and aerospace defense is not performing well. Time to maybe do another term, asset reallocation, or cut back or my exposure or positions in there. So now you can start to see another thing. This is a proprietary moving average concept of volume, but using it in terms of percent change, as I mentioned earlier. Well, quite frankly, you can clearly see that the volume started to dry up in aerospace defense way at the beginning of the year. And quite frankly, it has done nothing. It's moved sideways since that point in time. So out of the indicators, the ones that I like best, obviously, is the A, relative strength. It's unique to an individual sector or a stock versus the benchmark. B, my volume indicator, which is more reliable than in recent years, the last 2 years, than on balance volume. Many of you, if you're Thinkorswim clients, you know I went around the country and since 2008 was helping to promote and how to better use volume trend indicators such as on balance volume. And that is something that I think we started to see a change in its reliability in recent years. Anyway, that'll be something we're going to discuss in an upcoming webinar. You're on our mailing list. You'll be invited to it. It's a free educational tutorial on what indicators we have, what are working, and how to best use them to make better trade decisions. Now let's look at one more factor in the market. When it comes to individual stocks, we do have the availability of looking at the breadth or advanced decline in the marketplace. And clearly, if we take a look at the top 6 stock indices right now, you've got the S&Ps, the NASDAQ, the Dow Jones, the NYSE, the New York Stock Exchange Composite Index there, NASDAQ Composite here, and again, the Russell. Now, we've been hell-bent on buying Russell up until like the last 3 weeks. It was both the advanced decline and the volume were in sync, moving up, trending higher. Why did we get out of this? It was near and coming a little bit. It's from seasonality perspective, it's not really the greatest time to buy the Russell, but I think what's happened is Johnny-come-latelys are sensing that it's best to be in domestic stocks. But what the Russell represents is non-dividend yielding, smaller capitalized companies. So with that said, and more geared to domestic companies. Now, we've had some amazing run this year in markets. Our track record's pretty good. And posting different stocks and our swing trades, we average our thoughts and observations a trade a week, and that does not include the ones that we have missed by pennies, on our pullbacks. We can get in. We'll be discussing that at the upcoming webinar. But what I wanted to get into, gang, was also to look at what is happening here with the S&Ps. Is this a market that we would say is getting ready to roll over and die? Well, the advanced decline, even with today's move, was weaker. We had 173 versus 323. We want to see if that trend continues and where we would to say, yeah, it's getting worse, and there's testifiable proof it's getting worse. I have 3 lines in here: fuchsia, yellow, and blue. Fuchsia is the actual advanced decline line, and then yellow and blue are moving averages. So if we get a consecutive series of lower high, lower lows out of the advanced decline, but we more importantly get a short-term moving average crossover a longer-term moving average, that would show that there is a significant change in the market sentiment, and the breadth of the market would start to show relative weakness, which means there are more stocks going down than there are going up. This has been, as usual, in times of past, we've seen a light volume rally, and this was a rally that was on less than spectacular volume. As you can see, the on-balance volume was weakening, and you can see even my little volume indicator down here was showing that the rally, we made newer highs than at least from the number 2 point to the number 1. This leg up, this leg up, this leg up. You can see corresponding volume trends. It was, this little move here was on greater volume. This move was on higher percent change in volume, and this last one, this one was on a depreciative increase in percent of change of volume. So what does that suggest to me? That each corresponding rally is getting weaker and weaker, and it's vulnerable for a deeper correction. If this indicator starts to show that larger capitalized stocks are holding the index value up, if more and more stocks start to trend lower while the index is staying up, then that would be more of a bearish sign. It shows more market internal weakness. This could be a delayed reaction, might take time, week or 2 or 3 down the road, but make no mistakes, this is the one indicator that's exclusive use to the overall stock industry, and one that we should all be focusing on, and we'll be discussing more of this in the upcoming webinar, so watch for that. Now, this is not something new. If you went out and probably looked at which was a very extremely popular book at that, it was called Mastering the Stock Market by John Person. Mastering the Stock Market. And if you look at chapter 6, it talked about volume, and it talked about, in addition, looking at the advanced decline analysis as well. And the exact topic that I just talked about with the moving average components, with the breadth of the market, is in that book. So it's actually kind of interesting. We gave a lot of credibility to the breadth of the market. It's in chapter 5 of that book. It is a huge chapter. In fact, it talks about the McClellan oscillator and advanced decline, how to use that line or that indicator properly. So with that said, we do not trade NYSE. We trade S&Ps, we trade the Dow, we trade the Qs, etc., etc. So with that said, if you're looking at whether or not you should be buying a market, keep this rule of thumb in mind. If a market, the general market, the S&Ps, and of course the I guess technology-weighted sector Qs are in an uptrend and in strong market hands, and meaning the breadth of the market strong, it's on good volume, then it's probably a good idea to remain long in your individual stocks. But we now see a divergence situation. It's developed over time. Look at the breadth of the market in the Dow, sideways to down. The advanced decline in the Qs broke out to new highs. The advanced decline in the S&Ps broke out to new highs. The advanced decline in the Russell broke out to new highs. This is not a consistent bullish market. This is a very selective market, and it shows rotation out of blue chip, high dividend yielding, maybe international names, and that's why Caterpillar and John Deere and things like that have sold off, and IBM, and therefore most of the technology, your Netflix, which we just covered, Apple, Google, Facebook, and that's all anyone wants to be in. But remember, man cannot survive on Facebook and Netflix. We need a little popcorn or consumer staple products to go with that. Anyway, I hope you enjoyed this little tutorial, what to watch, what we're looking for, and where and when do we get the signals that say the big kahuna meltdown is coming. And I think you see a price depreciation with erosion in the advanced decline, and that will be the trigger. I think a lot of institutional traders are watching for that type of setup, and that's what I've just laid out here with the S&Ps. Until we meet next, I hope you found this both educational and, again, useful in your trading endeavors. Thank you.